Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is September 26, 2022, and I'm going to go over your three threes for the week. I'm going to go over the top three market movers, economic data, and performance for the week, and our favorite three asset classes, and how we are positioned on the short term for equities and bonds. So let's jump on in.
Okay, let's go over the top three market movers for the week. September 26, 2022. Number one, we have the Fed and the interest rate hike from last week. And number two, it was a very volatile and down week in the market. And number three, the chart of the week, which is the put option volume. So let's talk about what the Fed met last week on Tuesday and Wednesday, and their interest rate decision was to raise interest rates by 75 basis points to 3.0 to 3.25 on the federal funds rate. The Bank of England also raised their key interest rate 50 basis points to 2.25. And the Bank of Japan, they're not planning on raising interest rates anytime soon. All right, so let's take a look. Now that we know that they raised 75 basis points last week, let's take a look at what they're going to do at the next meeting, which is November 2nd. There is a 75% chance that they're going to raise another 75 basis points. This would be the fourth time in a row, putting that at about 3.75 to 4%, okay, on the interest rates heading into November. But let's go ahead and look out even a little bit longer. And like I said, November, 75 basis points to 3.75 to 4. December, the Fed funds futures are at 50 basis points to 4.25 to 4.5. And then in February of next year, a 25 basis point hike to 4.5 to 4.75 to get us in this range. Then there is a pause in the futures. And then the first rate cut is September of 2023, and then more rate cuts all the way through 2024. So that's the picture of how it's going to look moving forward. All right, so let's take a look at some of the economic data for this week. On Tuesday, we have some more housing data coming in the form of the Case-Shiller Price Index and the new home sales for August. On Thursday, we have the final and third revision of the second quarter U.S. GDP. Remember, the first revision was negative 0.9, the second one was negative 0.6, and the estimate for the third is no change, coming in at negative 0.6. Now, I know that that's kind of old news. So let's take a look at what the Atlanta Fed is looking for the third quarter of this year. And right now, their estimate is a measly 0.3% for the third quarter. So where is the growth? It's not in this market. The blue chip consensus, which is basically the average of a whole bunch of forecasts, actually have us coming in negative again for the third quarter. So we won't get this number for about another month, but everyone will be watching this next month in October to see if this was the third quarter in a row that we were negative. All right. But the real market mover of the week will probably be on Friday. It will be the PCE price index for August. Again, keep in mind that this is the Fed's favorite gauge to look at, even more so than the CPI, and I'm going to go over that here in a second. And the Michigan Consumer Sentiment number for September will also come out on Friday. All right. So why is the PCE important that's coming out on Friday? Well, if you remember a couple of Fridays ago, we had the CPI came up, and it was a huge market mover. And everyone knew that energy has fallen, but the surprise was the core CPI, which takes energy out, it actually went up. That was a huge surprise and a downward move in the market. Well, guess what? The PCE and the Fed's favorite gauge is very similar. The regular PCE is basically going to be down to flat, where the core PCE taking out energy looks like it's going to have a slight uptick. So this will probably move the market on Friday. So it's something that we've got to keep an eye on. All right, so let's take a look at the major asset classes, how they did for the week, and how they're doing on a year-to-date basis. Well, as I just explained, the only positive, or one of the only positives in the market, was the U.S. dollar. All the other foreign currencies took a bath. So did bonds. So did equities, down between 4 and 6.5%. Gold, commodities, Bitcoin, you name it, everything sold off last week. Okay, on the year-to-date basis, the only two winners are still the U.S. dollar and commodities, where we have bonds down double digits, 13 and 14%, and a lot of our equities down over 22%. And Bitcoin not doing very well, down about 58%. All right, so let's go over the chart of the week. This is the total put option volume. Okay, so there was a big rush for everybody to hedge their portfolios. They've been hedging all along, but all of a sudden on Friday, the largest S&P put volume of all time, 33 million contracts were traded on Friday. Okay, now here's the possible good news. Okay, that after the last previous three largest put volume surges in the past 3 years, we saw the strongest trend reversal. Okay, that's a lot of that has to do with everybody loading up on one side, and all of a sudden, if this market turns, they're going to have to cover a short covering rally. All these puts, they're going to have to turn around and cover, which could take this market going the other way. So we shall see. It's happened the last 3 times. This could be the 4th. So this is a slight positive if we can get some traction and get this market moving in the right way. All right, so let's go over the top 3 asset classes for the week on a long-term basis. Guess what? No change. This is the way it's been for a long time now. We still have T-bills, U.S. dollars, and utilities, and still the defense is the primary driver of this marketplace. But let's take a look how we're positioned on bonds on the short-term basis. We have a year-to-date drawdown to 13.6. Like I said, it's been a huge major loss on the bond side as interest rates have more than doubled. The 10-year interest rate has gone from 1.55 to 3.7 as of Friday. And as of this morning, it looks like it's going to go even higher. But we went to protect mode about a month ago on the bond side. Okay, we tried to nibble in here, turned around, and basically got right back out. And now the bond index or the bond prices have dropped even more because the yields have gone up. All right, let's take a look at how the equities are doing. And right now, the equity year-to-date drawdown is 22.5%. Not good at all. Again, we've been through 3 protect modes. Again, we go over this every week. We traded down after we had gotten out, went to protect mode. We had traded down into our support zone, went back up, touched the resistance zone, came back down and touched the support zone. And I said, if we break that, we will retest the lows. And guess what? We broke it, and we are retesting the lows back in June. Now, what I do want to point out is that there is another level below this. So if those lows from June don't hold, we could even go down more, down to the 3,400 to 3,540 level on the S&P 500. So let's hope they hold and we can get a bounce. But if we don't, that's probably the next level they're going to go down to. Okay, that's it for this week. Thank you for joining us. As always, our next update will be Monday, October 3rd. And as always, please continue to comment and like and subscribe to our channel. We do these again every Monday to provide you the information for the week. So have a wonderful week trading, and we'll see you next week. Thank you.